Why we're here? First of all, I think it demonstrates the amount of interest that we've seen in these new legislation changes, the fact that so many people have come out tonight. You've already made the first step. There are circa 8,500 property lawyers across the UK. The vast majority of those property lawyers are not aware of the changes that will take place in 3 weeks' time. So the people in this room already have a head start. And we've spent the last 3.5 months talking to as many people as we possibly can. That's been helped tremendously with the Law Society in terms of the fact that we're the endorsed partner and the fact that we're giving presentations up and down the country now on a weekly basis. We did try to do this 18 months ago. We didn't get much traction. But with 3 weeks to go, everybody now wants to know what it's all about. So the purpose of today is to enhance your understanding of capital allowances. We're not here to do a half-hour session on exactly what capital allowances are, but we are going to give you an overview, and I'm sure the vast majority of you here will already have an understanding. So we'll keep that to a minimum, but it's important that you understand what they are. And David will be taking that session. Okay. We're also then going to talk about the legislation changes that take place on April the 1st, stroke April the 6th. Some of those changes really, for clients that you're talking to today, it's already too late. And we'll talk about that and the potential risks you've got there and what we might be able to do to mitigate that. Okay. And of course, your role in a commercial properties transaction. You clearly do this on a regular basis, on a daily, a weekly, monthly basis. We're talking there about S198, CPSEs. I won't ask for a show of hands, but in terms of the CPSE document that you all complete or your vendors complete, February the 28th, a brand new version of this came out. I'm sure you're all using the brand new version that came out 11 days ago. We did see a document 2 days ago that wasn't this version, wasn't the last version, wasn't the version before that. It's critical that you get the correct version and the latest documentation. We'll talk about where you can access that later on in the presentation. Okay. So in terms of an agenda, 8 quick points. What are capital allowances? The purpose of capital allowances, why they were introduced, how they benefit clients. You know, Lee made a fantastic point. They really bear sometimes no resemblance to the purchase price of a property, but they are vastly significant when it comes to negotiating that purchase price of a property. And the lawyers that understand that will give their clients a real edge. The principles behind the types of clients that qualify. Again, we get asked that on a regular occasion. On a daily basis, we get asked about clients that can and can't claim. And it's critical we get that right. Okay. An example of a claim, we'll talk about a lawyer's building. This was a building that was purchased by a lawyer or a law firm, and we'll give you the impact that made to the partners that purchased that particular building. Okay, and what would have happened if it hadn't have been done the way it was done. Okay. The legislation then, in terms of the 3/4 key points that must be adhered to every time a transaction takes place in 2.5 weeks' time. The process in terms of how we go about doing the piece of work we do, which I'd like just to focus on one thing. It takes approximately 8 to 12 weeks to do that. You might come to us with a week to go before a transaction goes through. There is no chance that client will be able to benefit, and the risk associated with that, it's critical that you get involved or you get an expert involved at the earliest possible occasion. The next steps, what we believe we should all take from this, and then questions and answers. Okay. So I'm going to hand you over across now to David, who's going to explain what capital allowances are. Okay, thank you.
Thank you, Mark. Good evening, everyone. Most of you will be aware that capital allowances represent a form of tax relief, a valuable form of tax relief. Capital allowances, of course, can be claimed on most items of plant and machinery, freestanding plant and machinery. If you've got businesses and you buy computers, you buy motor vehicles, vans, capital allowances are claimed on those, and accountants will claim those because they have an invoice for the item of expenditure. And an accountant wouldn't bat an eyelid at claiming capital allowances on those. What they don't spot so easily are the fixtures which are internally embedded within a commercial property. And that's really what we're here to talk about tonight, as you know. So it would be quite normal for an accountant to be given a completion statement, and for accounting purposes, let's say that their client has purchased a commercial property for £1 million. That £1 million will end up in land and buildings in the balance sheet. In fact, what we're going to see in just a moment is perhaps something slightly different. And if these allowances are claimed, the whole idea is that the taxable profit or income of the tax-paying entity that owns that property will be reduced, and in some cases may be turned into a loss. And there are certain things that can be done, interesting things, that can be done with a tax loss in that respect. So we'll try to demonstrate here just what happens in very, very simple terms. Most accountants would tend to stick 100% of that purchase price in land and buildings on the balance sheet. But for tax purposes, what we're able to do is to extract a proportion of that purchase expenditure and to apportion it in a just and reasonable way, as required under Section 562, Capital Allowances Act 2001, to plant and equipment, fixtures, and so on. And it's that 25% in my little pie chart there that represents what we can claim tax relief on. Yeah. So the purpose of capital allowance is obviously to encourage investment, if we're looking at this from a sort of macroeconomic point of view, to apportion the intrinsic fabrication of commercial buildings. The legislation is constantly changing. I've mentioned down at the bottom, if you come across annual investment allowance, WDA writing down allowance. So for example, back in 2008, there were changes in terms of writing down allowances. And in fact, the annual investment allowance was introduced in 2008, enabling effectively a first year allowance, a lump sum, to be claimed as tax relief. The amount that can be claimed in terms of annual investment allowance has changed year on year. It stands at £250k per annum as we speak now, and will drop to £25,000 next January. The writing down allowances, so you buy a property for £1 million. Let's say that, going back to my previous example there, the pie chart, let's say that there was £250,000 of qualifying fixtures within that property, eligible for tax relief. I'm just thinking about that at the moment, this year in 2014. If I've got an annual investment allowance available to me of exactly 250k, which unless I've used it up on computers and vans and things like that, I may well have as a business or a landlord, I can actually then get tax relief on the full 250k of expenditure this year. So I've got 250k annual investment allowance. Yeah. Anything in excess of that, if I couldn't claim it all this year, I would then carry forward and I'd get writing down allowances at either 8% or 18% per annum moving forwards. But I'm still getting tax relief. Okay, is everybody all right with the sort of principle of the annual investment allowance? It's an upfront, if you like, immediate form of tax relief. What people don't often understand, and I actually get some accountants who are quite surprised at this, it's a landlord, if we take a landlord that is letting a commercial property, there's a rental stream coming in, there's some expenditure going out, maybe some mortgage interest that can be deducted from the rental income for tax purposes, maybe some repairs and maintenance, and so on. Where a property owner within their property business like that, an investment business, incurs a loss, it's usually thought that the only thing that can be done with that tax loss is that it can be carried forward and used next year against the rental profits that arise next year, or maybe the year after, or the year after that. There is actually an exception to that, and it's capital allowances that provide us with that exception, and this does enable those landlords that may actually not be making any profit from their commercial property venture to create a loss. Because by calculating the capital allowances, deducting those capital allowances from their, what would have been their rental profit or indeed rental loss, we can actually utilise the excess allowances against their other income, salary, dividend. So you can see how, from a tax planning point of view, this can actually get quite exciting. Unfortunately, sideways loss relief, the ability to move excess capital allowances and offset it against the likes of salary, dividend income, has been restricted a little since April of last year. But there is still an opportunity to potentially get tax relief for expenditure against other forms of income. So the claim principles, the property should be a commercial property. This does not apply to residential properties in the main. We've quoted some examples there: offices, warehouses, GP practices, etc. Some of those there, particularly care homes, GP practices, dental surgeries, can be quite capital intensive, quite capital rich, fixtures rich, in which one would expect a larger percentage of the pie chart, perhaps more than 25% in some cases, of the purchase price to fairly and reasonably be attributable to fixtures. If we're talking here about a commercial property that's perhaps a warehouse with a shutter door and a radiator, you would expect a relatively small percentage of that purchase price to be apportioned to fixtures. Now, in terms of who can claim, any UK tax-paying entity that we look at there, and I've listed them there: sole traders, partnerships, LLPs, limited companies, trusts. So any entity that pays UK tax and owns a commercial property, this applies to. I think, Mark, I'm going to hand over to you to do the next couple of slides.
Thank you. Thank you, David. So let's bring this to life. So, not David's presentation.
Thank you very much.
Let's bring this slide to life. We talked there about the types of buildings and entities that can be utilised, capital allowances. This is a real building purchased as a testimonial and a case study for us now. So the client is happy for us to talk about it. We won't give the actual name, but it's a law firm. It was an £8 million office building that was purchased. It was purchased in an LLP, and it was purchased by a number of the senior partners. Okay. So, they paid a fraction over £8 million. In terms of the capital allowances who identified, it was again a fraction over £2 million. The interesting part here was they were about to refurbish part of the building, and they said, okay, well, we'll refurbish and then we'll call you in to do the work. Stop. The last thing you want to do is to rip out all the items that are claimable for relief and replace them with new items. Because the items that are already in there will do the work, we will do the work and identify those items, we'll identify the values, we'll produce the report that allows the client to claim the tax relief, and then you take those items out. You can still claim on them, and then the new items that go in, we go back and we do the work again. So you get a second bite at the cherry. Okay. The amount of clients that call us in after they've done the refurbishment work, and all the value is sat in skips outside the office building. So a really, really common mistake. So let's make sure we don't make that mistake. So what did it mean? We've talked about tax relief and annual investment allowance and write-down allowance. This particular client or the particular partners are 45% taxpayers. They're lawyers, so of course they're 45% taxpayers. £917,000 of tax that they would have overpaid if they'd not done a capital allowance report. £917,000. Now, it doesn't really matter whether you're going to get that in one hit, well, it probably does if you want to spend it when you're in one hit, or whether that's written down over a number of years. The point is, if they'd not allowed us to go in and do that capital allowance report, create the information, produce that document for their accountant, and their accountants submit that to HMRC. It's a very straightforward process at the back end. They would have lost £917,000. Approximately 800, could you just pass that document there, please, David, the document from. Approximately 800 transactions per month. This one here. Thanks. According to HMRC, so this is their document, and you know, people use statistics. These are not statistics, this is factual information. Last year, the previous year, and the year before that, just over 98,000 non-residential properties were transacted upon each year over £40,000 worth of purchase price. So let me just read. So 98,000 non-residential properties. We typically start our work at a purchase price of £500,000, of which we envisage 10% of that. So what we're saying is 10,000 properties, 9,800 properties per year over the last 3 years, which I'm sure we'll all agree is probably one of the most challenging periods for commercial property. The year before that was 97,000, the year before that was 102,000. So it's fairly flatline at circa 100,000. That means that approximately 10,000 commercial properties each year are transacted upon. So that's 800 a month. This year, we do circa 100, 120, 130 commercial property. We act for that amount of properties on a monthly basis. And this year, we did less than 6% of all our properties were properties that were transacted upon in this year. So that's properties that were transacted previously, retrospective properties that were bought 4, 5, 6, 7, 10 years ago. We do more than the rest of the marketplace put together. So the assumption is that there's probably 100, 200 of those 10,000 properties that did this exercise. And what we're saying there is that that particular law firm, if they hadn't done the exercise, it would have cost them £917,000. Now, I'm not the lawyer, you guys are the lawyers, and the implications of not highlighting that to a client and not carrying out the process I'm going to talk about now, I guess you can work out. Okay. So, what do you need to do? The April 14 rule changes, there are 3 key elements that you must adhere to, okay, for any transaction that takes place post April 2014. And I can see some people actually starting to write some stuff down, so that's really good. What I would say is, at the final slide, we have a registration portal, and you've all got documents there, a piece of paper on your chairs there. All the information we've got here is in PDF format on that registration portal. It's free of charge. It's a service for the Law Society members, and it will give you access to documentation. So S198 written correctly. Not that I'm saying you would never write an S198 correctly, but they're there for your use. The latest version of the CPSE, 3.3, which I know you're all using, it came out on the 28th of February, but it's there again. And the purpose of that portal is it allows you to make sure you're absolutely right up to date. Okay. We also have a helpline number for any quick question. Lee talked, I'll be careful because you might know who Lee works for, but Lee talked about some of his partners, and if they want information, it's just a phone call. Pick the phone up, make the quick call. This is what I'm about to do. Is there any feedback? Do I need to do anything? Is there anything I should be aware of? We answer that free of charge. There's no charge for that service. And we'll do that on an email or by phone. Okay. So what do we need to do? So the first thing is, we've talked about these terms, mandatory pooling, and we've talked about capital allowances. The seller needs to identify the allowances that are available. And they have to do it with documented evidence. So that means you need to get somebody, whether it's us or any other expert, you need to get somebody that understands what they should do to produce that report. And in actual fact, on the CPSE document, I don't know why I keep doing this, you can't read it, but on this CPSE document 3.3, the final question, which is section 32, question 10, it now actually asks you to name the capital allowance expert or advisor that you've utilised for the transaction. It's never done that before. This came out 11 days ago, and it will catch a whole bunch of people unawares. So it's actually physically asking for the name of the company that you've used now. Okay. So that piece of work needs to take place. There's a slide after this, 2 slides after this, that demonstrates it takes between 8 and 12 weeks to do that piece of work. Now, we have done it in 4.5 days. When we were right up against it for a client, the client was a £63 million purchase of an estate up in Carlisle. No allowances ever claimed by any previous owners, just ignored, missed every time. And we had 4.5 days to meet a tax deadline. It took I think in the end, it was about 7 forensic surveyors that were up there from day one, and everybody was literally working 24 hours a day, and I'm sure you've all done that type of thing occasionally. But we don't really want to do that, and you don't really want to do that. Transactions can take a lot quicker than 8 to 12 weeks. So it's critical that as soon as the property is going to go onto the market, notify straight away. Have a conversation, ask the question, and we'll tell you the things that need to be done. Whether you engage us and use our services is your call and your client's call, but please just speak to us. At least then you'll know the action you need to take. Okay. So, once they've been pooled, the CPSE needs to be completed correctly. It's not sufficient anymore. It never was sufficient to put not applicable, unknown to Section 19. I know everybody in this room has never done that and never asked their clients to do that, but other lawyers have. You can't do that anymore. Okay. The questions are a lot more descriptive now. And probably for me, the question 32.10 should actually be 32.1. That should be the first question. Who have you used as a capital allowance advisor on this project? Because when you get to that question, there's nobody. Go and find someone now, quickly, before you transact on the property. So, that needs to be completed correctly. An S198 election then needs to be entered in by both parties. So the seller has identified that there is £1 million worth of allowances on their £5 million building. Both parties then need to agree, and that's where the negotiation comes in. And again, we'll get the odd question, well, I believe we have 2 years to agree this figure, so we'll just do the election after the event. And I don't believe that anybody in this room has not experienced where a transaction has gone through and it's really smooth, and in 2 years' time or 18 months' time, both parties are really talking on a fantastic terms and they're happy to divide up this piece of cake. No chance. It's far too late. You've got to do it at the time. Both parties, if they are still talking, it's almost impossible to get that to happen at the end. So the time to do it is prior. So the election gets created, the S190 election, worded correctly. The final part, and every single month we unwind S190 elections that are not written correctly. So they're not worth the paper they're written on. So the final part is that information, those elections, both have to then be notified to HMRC. So HMRC have to have that information. This is where, at the moment, the legislation, and I'm sure you've all come across it, the point about HMRC is they might make something slightly ambiguous, allowing them to then tweak the rules as they go along. So at the moment they are saying within 2 years, well, within a reasonable time frame, which we all deem to be 2 years. Should there all of a sudden be a massive surge in these reports coming through, then I think we can all guess that that 2 years will be reduced down to a month, 6 months, 3 months. We have no idea. Okay? But the point is, let's make sure we're doing it right now. Because the next problem that there's going to come about is all the previous clients you've acted for over the years, every one of those clients is sat there with the potential opportunity to claim tax relief. So if you've got a client you acted for 4 years ago and none of this was done, and David will touch on this, then there is an opportunity to go back to that client and say, we have some great news for you here. Those allowances might still be available. Okay. So, mandatory pooling, identification of the allowances, point 1. That must happen by the seller. The purchaser can't decide to do it after the event. It's too late. They've gone, they're lost. And when I say lost, they're not just lost for the seller, they're not just lost for the buyer, they're lost for any future buyer forever under the current legislation. So the £817,000, £917,000, sorry, that was there, that is gone forever. No one's getting that back. And I think that's a particularly awkward conversation when you sat down with the client saying, we missed that one. Okay, and that's an £8 million property. London average property price we work on between 4–4.5 million in terms of the average. Large percentage in the tens, typically sort of 10 to sort of 25 million. In the north, a little lower, circa £1 million. Okay. So you need to pull the allowances. You need to create the election. That CPSE must be completed correctly. We can't leave them in a room to let them tick boxes. It has to be completed correctly. S190 election created, both parties notify HMRC. Okay. And as long as that takes place, then there isn't an issue. You've got a delighted client. Okay. But you must do this. In terms of owners who purchased post-2014, that purchased a property pre-2012, there is no impact whatsoever. Okay, so if I bought a property and I bought it prior to 2012, I don't have any issue at all. Business as usual. One of the comments I got asked by somebody was, well, if the business as usual, so I bought the building 5 years ago, I don't need to do this work now, I can wait until I decide to sell the property, and I'm going to sell the property in 3 years' time. What we're really saying is I've overpaid my tax for the last 5 years, and what I'd like to do is overpay that tax for the next 3 years as well. And then I'll go and ask HMRC for the money back. Do it now. It doesn't matter that you're going to sell it in 3 years' time. I don't believe anybody in this room would sit there with a bunch of expenses and say, I'm not going to claim those for 3 years. HMRC need the money, the company's got a few problems, the country's got a few problems, let's leave it with HMRC. Get your clients to act upon it now. It's great housekeeping. Okay. I'm going to hand over now to David. I'm a David. Do you want me to do this one? You're doing this one. I'll hand over to David.
Thanks, Mark. I think you've probably touched on the implications to clients if you do nothing. Obviously, in terms of transactions that are taking place from this point on, those repercussions could be quite serious. And it may not just be your clients, whether it's the vendor or the purchaser that you're asking for, it could also be subsequent owners, as we'll see in a moment further down the line, that will be precluded from making any form of claim for tax relief on the property by virtue of the fact that the correct steps were not taken now at the time of the post-April or the next post-April 2014 change of ownership. So just to summarise here what the situation is, in this sort of window between April 2012 and April 2014. So the relevant dates here are 1st of April for corporate bodies and the 6th of April for individuals, partnerships, etc. So the point that we've made, a purchaser buying between April 12 and April 14 from a vendor who has not made a capital allowances claim in the past, and that's probably most of them, it's business as usual. It's pretty much what Mark said. The buyer, so if somebody buys today, literally today, because we're still in that window, you check to make sure, they've checked to make sure that the vendor hasn't made a claim, then you could ask us to come in, and based on your client, the purchaser's purchase price, we could do a just and reasonable valuation of the fixtures. And that's fine. The problem that you've got just right now at the moment is the second point there. A purchaser buying in that window, and remember that we're 23 months into that window now, where the past owner has made a capital allowances claim, then a Section 198 election must be filed within 2 years. If it isn't, and I'm sure in most cases it is, but I'm just saying that if it isn't, then the purchaser and all subsequent owners of the property will not be able to make a claim for tax relief. So that's the situation we're at the moment. It's only an issue at all if the past owner has already made a claim for capital allowances. Yeah? So it's important to agree on the transfer value of those allowances to the purchaser and to do a Section 198. Now the situation that changes in a few weeks' time, post-April 2014, where the taxpayer, this is all taxpayers, any individual limited company, acquires the property from April 14, the fixed value requirement must be met. Now this essentially in most cases will mean a Section 198 election or a Section 199 election. So in other words, the parties have to agree on a transfer value, and yes, they can agree on £1. You can still do that if that's what you want. Just bear in mind that if you're acting for the purchaser and you happily go along with £1 as the transfer value for the fixtures, your client is going to get tax relief on £1, and that's not worth an awful lot. And that's a situation that has arisen in the past. What's important is perhaps to do that, and it hasn't always been done, to do that just and reasonable apportionment. So the second point there, which is really important, the vendor must have pooled the allowances. Now what that actually means, if you think about it, is the vendor must have actually brought a disposal value for those fixtures into his capital allowances computation. Now to all intents and purposes, what that means is that the vendor has to have done a capital allowances claim. And that's where clearly we see an opportunity, because we can step in and do the capital allowances claim, work out what that, if you like, true and fair transfer value for the fixtures should be for your clients before they sell. Because they're going to have to do it when they sell. And as Mark said, why wait 3 years, 4 years, 5 years to get that tax relief when in fact you could have been having it all along? Yeah, so by the time we get to the transfer date, it will be important that the vendor has made a claim and pooled the allowances. And in addition to that, both of those have to be satisfied. It's not one or the other, it's both. A Section 198 election needs to be made. Mark, just to finish off, I'm conscious of time. I shall pass over to you.
Right, there's 3 slides, they'll take a minute each. The first slide is the process. It's 8 to 12 weeks. It's due diligence, establishing no one else ever made any prior claims on a building. It's ensuring we send a forensic surveyor into the building to measure, photograph every item that's there, bring that back in-house, and we have a technical writer who then produces a report. That report goes to the accountant. The accountant agrees the report and then submits that report to HMRC, upon which point, 24, 25 days later, the client will receive a cheque back or rebate for whatever they are due that first year. Okay, so not the full 900,000. In that case, it's a percentage of that, and then so on and so forth thereafter each year. So that's the impact. It takes 8 to 12 weeks. I know I've said it and I'll keep saying it again. Please don't come to us and say, we can exchange contracts next week. You're going to put us under massive pressure. I'm not saying we can't do it, but it's typically 8 to 12 weeks. If everybody's got the paperwork together, or when everyone's pulling together, we can do it quicker. But that's typical. Okay. We have literally a few bullet points on us. It was already mentioned by Lee, thank you. 4,500 clients that we've completed this work on, and we're currently in the middle of completing this work for. We are the Law Society endorsed partner, which we're extremely proud of. We are also the affinity partner for the ICAEW. So for accountants and lawyers across the UK, the 2 main bodies, there is only one partner, and that's ourselves. Okay. In terms of the BHA, which is in terms of the British Hospitality Association, we're also their preferred partner of choice. Hotels are particularly good for capital allowances. It works really, really well. Okay, we've done several large chains. Since we're an ISO 9001 accredited company, we do things in a particular way. We do it the right way, we believe, and we do it in a methodical way, and it's a documented way. As one of our doctor clients said it to me, it says you're serious about your business. Okay. And we have offices in Manchester, London and Birmingham. 2 offices in London actually now. Okay. So wherever the client is, it doesn't really matter. Okay. So next steps. So the one thing I would advise, that there is a form there. This is all about just asking the question, making sure that you've got the correct information, the correct advice. So whether it's a quick phone call into the office, whether it's a quick email into the office, which we get more and more, we're not quite into double figures every day, but it's increasing daily in terms of the amount of people asking for us for advice. We don't charge for that service. You know, our view is that people will listen, they'll take that on board, and then further down the line, the client then might engage us. Okay. The documents we've mentioned, as I've said, are all on that portal. So once you've registered, you've got complete access to that, and we then inform you on a monthly basis in terms of updates and anything that's changed. Okay. Thank you very much for your time. Appreciate it.